Good morning. It's Thursday, the 13th of February, and this is Govindraj Ethiraj, headquartered and broadcasting and streaming usually from Mumbai, India's financial capital, but in transit right now. The top headlines and themes. The bulls and bears fight it out once again on Dalal Street as the markets slip for the sixth day. Consumer price inflation is down to a 5-month low. Will another round of rate cuts come? India is gearing up for a major gas sourcing and distribution push, including for liquefied natural gas or LNG. A new tax bill is almost here, and early reactions suggest more was expected.
This is the Core Report with Govindraj Ethiraj.
The bulls versus the bears. It was a mighty battle between the bears and the bulls on Dalal Street once again on Wednesday, with the final hours resembling the last overs of a one-day international rather than a stock market. Of course, we've seen this before. The bears finally won this round, with the Sensex closing at 76,171, down 122 points, having moved in a roughly 900-point range through the day. The NSE Nifty50 was down 26 points to close at 23,045. Some of the financials did well, while some of the big index heavyweights like Reliance Industries did not, and neither did Mahindra & Mahindra and Eicher Motors. Amongst the broader markets, the Nifty Mid-Cap 100 and Nifty Small-Cap 100 were down, but only slightly. At this point, the Sensex and Nifty have fallen for a sixth day in a row, as we've said. The reasons have not changed. The persistent selling by foreign portfolio investors, now over $10 billion, weak third-quarter results, and valuation concerns over smaller cap stocks, the latest bogey, so to speak. There is, of course, the big concern on tariffs. So, should tariffs on Indian exports to the United States affect India? Well, let's recap that a little bit. To some extent, it could affect the fortunes of companies who are exporting, for example, the pharmaceutical industry. Going by the words of a Indian Drug Manufacturers Association official who was on our show yesterday, it is possible that there will be tariffs, but it's unlikely that the tariffs will be significant, if at all they're there. The reason is that healthcare is a sensitive issue, and prices of drugs and other health-related products are obviously sensitive. India exports about $27 billion of pharmaceuticals. About 30% goes to the United States. Now back to the markets. Equity-oriented mutual fund schemes pulled in about 39,000 crores in January despite a sharp sell-off in the market. While the inflows were about 3.6% lower than December, they were still 21% above the average monthly inflows for calendar year 24, according to Business Standard. Now, the segment breakup is interesting given the focus on small-cap mutual funds and their perceived or likely struggles. Amongst the 11 equity subcategories, thematic funds received the highest net inflows at 9,000 crores, small-cap funds at 5,700 crores, and flexi-caps at 5,698 crores. A lot of mutual fund advisors, by the way, are now directing funds or trying to direct funds into flexi caps. Now, inflows into small cap funds had increased by 22% month on month, despite a significant decline in prices. What is clear to me, at least, is that we cannot take the supply side as a positive for the market, which is that just because people are putting more and more money into the market, including through systematic investment plans and mutual funds, that does not mean the market will keep going up. Now, this is something that we've discussed, argued, and concluded many months ago as well, but it's a good reminder. And while the blame is being dumped on foreign portfolio investors for selling, which is that figure of more than $10 billion this year, a lot of Indian funds, including private funds and alternative investment funds, have also been selling, as fund managers have been telling me in recent months. Incidentally, in January, the Nifty Small Cap 100 Index fell about 10%, which was its worst monthly performance since May 22 and the third worst since COVID-19. The Nifty Mid-Cap fell about 6.1%, and that was the steepest drop since October 24, according to Business Standard, which also said that the market rout continued in February with the Nifty Small Cap 100 and the Nifty Mid Cap 100 falling another 5%. By the way, at their session low, the small caps were about 21% below the record high levels hit on December 12th. That's 2 months ago. However, they've closed now at about 18.7% or just about 19% below their all-time high. A close of more than 20% below a record high indicates that the underlying stock or security has entered a bear market. The mid-cap index is about 17% from its record high, and therefore both the small-cap and mid-cap indices remain in correction territory, which is about 10% below the record high, says the Business Standard. Now, all of this is obviously to help you determine if we are circling the bottom of the market, so to speak, or still a little distance away from it. Now, the data is obviously saying that we're close to the bottom. But then there is the matter of sentiment and how you view it. Legendary emerging market investor Jim Rogers told Business Standard that the whole world, including the US, is overdue for problems. That's because he says nearly all stock markets around the globe have done well recently. He says he's invested in India many times in his life, which is of course true. And he also believes that the central dispensation, that's the central government in New Delhi, understands the Indian economy and what all needs to be done. And therefore, he says he's more optimistic about India than before. And for the first time in his life, he says he's actually enthusiastic about India, though he's been visiting, and I can say that for a fact, maybe for about 25 plus years. Now, there is, of course, a but to what he's saying. He says he does not like to buy markets that are making all-time highs. As a rule, if the markets are correcting and investors are not worried, I do not buy, he says. So if the markets were to correct in India and investors are depressed, worried, and despondent, I would probably buy Indian stocks. Now, this is, of course, keeping in line with what most veteran fund managers would say. So this is your non-data answer to what is a good time to buy if you were asking that question. Because Rogers says he's sold out from nearly every stock market in the world right now, except China and Uzbekistan. He also sold Japanese shares, but too soon, and that was his strategy. He owns Chinese shares mainly, but they have not seen a vibrant recovery post the COVID pandemic. Finally, he says the Indian stock markets are overreacting to global developments, especially related to Donald Trump. And once again, if the Indian markets go down further, he hopes he can buy stocks here again. And he wants Indian markets, therefore, to go down, which is exactly what any fund manager would be hoping, regardless of what they say at this point of time. Inflation falls to a 5-month low. Moving on from markets, some good news. India's retail inflation has slowed to a 5-month low in Jan as food price inflation cooled off, increasing the likelihood of another rate cut in April. Annual retail inflation was 4.31% for Jan, lower than the estimates of 4.6 and 5.22, that's the band, by most economists, according to Reuters polls. Retail inflation was at about 3.6% in August 24. All of this is according to data released by the Ministry of Statistics and Program Implementation. Interestingly, the data shows higher inflation in rural areas at 4.6% compared to 3.87 or 3.9 in urban regions. Food inflation slowed in January, though it remained high at about 6%, thanks to high prices of vegetables, fruits, oils, and fats, and that was about 8.4% in December. In January, vegetable prices rose about 11% year on year. This compares to 26% increase in the previous month. So net vegetable prices are still quite high. So will all of this and the imminent rate cuts or likely rate cuts help the economy pick up pace? I reached out to Aditi Nayar, chief economist at rating agency ICRA, and I began by asking her what other signals she was seeing in the economy before coming to the interest rate question.
So basically, let me start with the CPI inflation number. It came in lower than we expected, and we're projecting it to fall further to 4% in February, which is going to be the last print that the MPC has when it holds its next scheduled meeting in April. And this is quite significant because 4% is that elusive midpoint of the MPC's medium-term target range of 2 to 6%. So if that is the case, that's going to be setting us up with a very high likelihood of another rate cut coming in the April policy itself. Now, when we look at what caused CPI inflation to fall between December and January, primarily it was food inflation, but it was not very broad-based. So a few items led to this correction in food inflation, particularly vegetables. But that's been a big pain point over the last several quarters. So it's not bad news in a sense. I think any fall in food inflation is very welcome. When we look at the Rabi output that is expected, the Rabi sowing right now and the reservoir levels, all of that gives us a good amount of comfort on the food inflation front going forward. Now, couple of other things that could, of course, impact the inflation trajectory. One is what happens globally in terms of tariffs and other policy changes and the impact it has on both commodity prices as well as on the exchange rates. Now, the CPI itself is not very sensitive to exchange rate movements. The transmission is typically lagged and incomplete. Incomplete in a sense that services inflation tends to not be affected by what happens with exchange rates because services tend to be pretty much domestically produced and consumed. As opposed to the WPI, which has a much higher weightage of traded commodities, tends to see a much quicker transmission of exchange rate movements. Other than that, we've had the budget, which has given an almost equal boost in terms of the capex increment, which is about 1 trillion between this year and next year, and the consumption boost in terms of the tax relief, which is also about 1 trillion. Now, my sense is that when we look at the per month average amount of tax relief, it's not huge. We think most of it is going to be spent. Some of it may also go into younger adults acquiring their first home, because there will be an improvement in the home loan eligibility after the tax cuts. And my sense is that the tax relief is probably going to be largely spent on services where the inflation has not been a big concern of late.
But you're really saying that's 6,000-7,000 rupees a month, right? Is that's the additional income in the hands of additional or potentially additional income? So you talked about the tariff uncertainty. So the uncertainties for countries which are raising tariffs, it doesn't look like India is going to raise tariffs. On the contrary, we've already, in anticipation, reduced tariffs, though the products on which we've reduced are very few at this point. So why would that be a concern?
The concern is what will happen to overall global trade flows if the US raises tariffs on additional countries going forward. And does that happen to India as well? So, firstly, we've already seen tariffs being increased on some countries and on some products. Now, going forward, is it going to be uniform across countries on certain products, or is it again going to be more country specific? And where does India get bracketed? So, we heard some signals in the last couple of weeks that India might get clubbed with the BRICS in terms of having a common tariff imposition. We don't know whether that is going to happen. So, we don't know how much our exports are going to get affected and on what items. And therefore, we are not quite clear on what will be the trend of the INR over the next few months.
The first rate cut has happened after 5 years. Another one is imminent, as you're saying now. Both come through in the next one being in 2 months' time. How do you see the overall impact on economic activity or the economy as a whole?
The interest rate cuts pass through very quickly into things like EMIs. So, there again, the tax relief and the potential EMI relief will give a boost to consumption. And where we've been most concerned over the last couple of quarters is parts of urban consumption. So, rural now is expected to do better with overall trends for the agri economy looking healthier. We expect rural demand to be more sustained going forward. But urban demand was extremely uneven. High end demand seemed to be very much intact. Mid level and lower income urban households seem to be more impacted by the fact that food inflation in particular was quite high over a period of time. So, if we do have food inflation coming down, we have tax relief for the salaried households, and we have EMIs which can potentially come off over the next couple of quarters, then all of this will provide a sentiment boost, and we do expect that consumption demand is going to be better. Now, that is also something that is going to be important for private capex to come back. In a global scenario where exports are quite uncertain, only when we have a lot more confidence on the domestic demand sustaining would we expect the capex cycle to significantly improve.
Right. And in a broad sense, in the past, we've seen that food prices have moved quite erratically, as in we've not really been able to predict, and particularly potatoes, onions, tomatoes, and so on, and maybe more tomatoes and onions. So given that, could prices again start swinging? Is that a possibility? And if so, are we ready for it or geared for it?
To be very honest, as a forecaster, I kind of assume we are going to have a vegetable price shock at some point in the year. I just don't know when and which item. Unfortunately, that definitely remains a risk. The other thing is that, in general, agroclimatic risks seem to be on the rise. So while I'm saying that, in the immediate term, the Kharif output was good, the Rabi sowing is higher than last year, and very importantly, reservoir levels in many regions are quite healthy, which takes away the anxiety related to the onset of the next monsoon to an extent. So all of this sets us up for a better outlook for crop inflation. But of course, you can have like freak weather events which create short term or, the pain as far as perishables are concerned and can also impact particular crops.
Right. Aditi, thank you so much for joining us.
Thank you.
India goes all out for gas. India's liquefied natural gas purchases are set to more than double by 2030 as infrastructure expansion and modest growth in domestic production prompt a jump in consumption, according to the International Energy Agency, which released its latest report on Wednesday. Demand for the fuel will rise to an annual 64 billion cubic meters by 2030, up from 36 billion last year, according to that IEA report. India is the world's fourth largest buyer and wants to sharply increase the use of gas in the overall energy mix. At this rate, that would mean an annual growth rate of 11% until the end of the decade, twice the average rate seen in the last 10 years. The increase part of an overall rise in demand from transport, industrial consumers, and refineries. IEA's Director of Energy Markets and Security, Keisuke Sadamori, said that India's gas market is entering a new phase of growth, supported by significant infrastructure development and clear policy direction. The prospect of higher gas demand in India coincides with an expected wave of new global LNG supply. However, it will require careful planning and market coordination to ensure supply security and to help gas to compete in a price-sensitive market, he said in a report quoted by Bloomberg. India is targeting the share of gas in its energy mix to climb to 15% by 2030, up from about 6%. Now, that 6% figure has not changed much, or rather remained mostly the same in the last decade. I spoke with Akshay Kumar Singh, a veteran of the oil and gas industry, also chairman and managing director of Petronet LNG, which right now owns 2 receiving stations for LNG in Kochi in Kerala and Dahej in Gujarat. Petronet LNG receives this gas at the 2 stations and distributes it across the country through pipelines and even through trucks. I began by asking him to describe Petronet LNG as the company and its current gas sourcing and distribution strategy for now and in the near future.
Petronet Energy Limited is a joint venture company promoted by 4 Maratha companies, IOCL, ONGC, GAIL, and PPCL, each having 12.5% equity share. And the company was set up in year 1998. It was first of all assigned the job of setting up first LNG terminal in Southeast Asia. And the first LNG terminal at Dahej was commissioned in year 2004 with a capacity of 5 MMTPA, meaning by 5 million ton per annum, the conversion of LNG into the regas. After that, the Dahej terminal has been expanded from 5 million ton to 17.5 million ton in the year 2019. Perhaps at present, it is considered to be the world busiest terminal, handling almost 260 to 270 LNG cargo in a year. Even though the capacity wise, there are some terminals in South Korea and Japan which has got more capacity than the Dahej LNG terminal, but capacity utilization wise and handling of more number of LNG cargo, Dahej is number one. We are in the process of expanding the Dahej LNG terminal capacity from 17.5 to 22.5 MMTPA. And very soon, the capacity expansion, probably in coming 3 to 4 months times, will be completed, and the Dahej terminal will have a 22.5 billion ton per annum capacity. In year 2013, the Petronet set up a second LNG terminal at Kochi with a capacity of 5 MMTPA. Unfortunately, due to some evacuation pipeline issue, the capacity utilization could not reach to desirable level despite efforts by various stakeholders to increase the capacity utilization. As of now, we are able to utilize that terminal at 22-23% capacity. But the Dahej terminal is almost operating at 100% capacity. So both terminal combined, capacity-wise in India, it is 43% of total LNG regas capacity in India. But this 2 terminal handles more than 2/3 of total LNG import in the country. So this is the unique feature of Petronet LNG, which is supporting the gas-based economy in our country. Last year, almost 51% of total natural gas consumption in country was met by imported electricity, and 49% was domestic gas. And Petronet share of handling those 51% was almost 70%. So we are a key player in LNG supply chain of India, and we intend to continue as a leader in this LNG business. And as a part of the expansion plan, we are in a process of setting up a land-based 5 million ton per annum capacity RLNG terminal in the east coast of India at Gopalpur in the state of Odisha. In fact, the Kochi terminal, which is a 5 million ton capacity, is being utilized at present 1 million ton, and GAIL is in a process of completing the gas pipeline connectivity from Kochi to Bangalore, and it is expected that during this year, probably in 6 to 8 months times, the pipeline will be completed and Kochi LNG terminal will be connected with the national gas grid, meaning thereby Kochi gas can flow to Nangal in Punjab, Guwahati in eastern part, or even Calcutta in West Bengal. So it will be the integral part of the national gas grid. And we expect that once this pipeline connectivity to Bangalore is completed, there will be substantial improvement in the capacity utilization of Kochi terminal from present 22-23% to probably going 60, 70, 80, 90 very soon. Going forward, in coming 3 years' time, Gopalpur terminal is made operational. Petronet LNG will be playing a major role in meeting the energy security of the country. This is what I brief you about the energy part. Apart from that, we are in the process of setting up a petrochemical complex adjoining to our LED terminal in the Haze. The capacity of petrochemical complex is 750 KTA per annum. The PBH, paint dehydrogenation plant, at 500 KTA of polypropylene plant. Apart from this two product, propylene of 750 KTA and PP of 500 KTA. We will also be setting up ethane and propane handling capacity at the head terminal. We are in the process of constructing a third jetty, which will be unique in the country, which will have LNG, propane, and ethane, three product handling facility, which is nowhere in the country. Propane is required for feedstock of our petrochemical plant. We need around 1 million ton of propane. And ethane is required for our associated and the promoters subsidiary company, mainly the Popal, GAIL, and other who need propane and ethane for their petrochemical plant. And going forward, when in 2028, our existing LNG contract from Ras-based Qatar, which is of 7.5 million ton per annum capacity, is expiring and it has been renewed for further 20 years up to 2048. And for the new terms of contract, they will be supplying lean gas and there won't be any ethane and propane. So presently, it is a rich gas which is being extracted by ONGC and being supplied running of Opal petrochemical plant. But from 28 onwards, to ensure the viability of feedstock for the power plant, we are in the process of setting up the ethane and propane handling capacity in Dahej.
Right.
The project has already been approved by our board of directors and it is at quite advanced stage of implementation. The licenses have been positions, they have done the basic design engineering package, the PMC is in position, all the long lead items which is identified had been almost tendered. There are 13 packages for long lead items. 11 have already been floated in the market. Tendering process is on. And we are right now on track. We have an environment clearance, we have a land, we have all the resources available, and we target to complete this petrochemical project by end of 2027.
If I were to ask, your current receiving stations are on the west coast, and you have a new one coming up on the east coast in Gopalpur, as you said. So, would the sources for LNG on the east coast be different from the ones on the west coast?
As on today, we have a long-term contract almost, you can say 90% of our capacity at Dahej has been tied up of long-term VC. And we have still 10%, which is untied, and it is being used for the spot volume. Going forward, when the new capacity is being added, our promoters and other off-takers are in the process of tying up the long-term and mid-term contract, and we are in discussion with them to add a mid-term or long-term contract for converting LNG into the regas. So the source would be across the world. It is not a particular country. It can come from anywhere in the world. And as we know that the major source of supply for the LNG is Qatar, Australia, and USA. It is the major dominant suppliers for the world. Almost last year, the USA became the number one supplier, almost 87 billion ton they supply. Earlier, it used to be Qatar. They are around 80 million ton, and Australia also around 80 million ton. These are the three major dominant supplier of the LNG, and many each from the different country across the world. So when the prices are reasonable and less volatile, lot of LNG comes as a spot volume, and the terminal which has a spare capacity only can convert it. And we have seen last year during the summer season, particularly May, June, July, the volume requirement for power sector, which normally corresponding to the earlier year, it was around 23 MF per CMD, it went to almost 35 MF per CM. So huge requirement of gas was there during the summer season. In fact, we are operating our gas terminal even at 150-140% capacity. So it is a chicken and egg theory. You have to create the infrastructure and also look for the opportunity whenever the prices are very reasonable. Lot of volume flows in our country, I guess, for volume, and we look for such opportunity in the future.
This segment was supported by the India Energy Week 2025, scheduled from February 11th to 14th in New Delhi, and you can register for the same using the link in the show notes. A new tax bill is coming. It's almost there, but not yet. The copy is out and doing the rounds, but it is yet to be presented in Parliament, so maybe some last-minute changes are possible. So, India will introduce a new condensed version of its income tax law in the lower house of Parliament on Thursday. This law aims to simplify the roughly 60-year-old rules that have led to, among other things, a barrage of litigations over the years. Last year in July, in the Union Budget, the Finance Minister announced that the government would simplify law to make it easy to understand and reduce disputes, and also invited suggestions. There were some 22 subcommittees that worked on it, and over 6,500 suggestions that have come in, according to tax experts I've spoken to. The new income tax bill will drop old and redundant sections of the law and bring it down to 622 pages from over 800 pages, according to the bill reviewed by Reuters. The bill includes tax rates in tabulated forms and removes conditions attached to legal clauses, making it easier to understand, also drops the explanatory footnotes to legal sections. Reuters says that income tax disputes have surged to about 13.4 trillion rupees or $154 billion as of March 2024, of which disputes amounting to 3.8 trillion rupees or 380,000 crores were added in less than 2 years. We will, of course, be looking into the new tax code or bill, but the early reactions from tax experts is that it's not delivered what it was expected to or is not meeting expectations. But we will dive into some details in the next day or two. That was the Core Report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the Core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in, and thank you once again for listening.